Everybody, and welcome to the Equifax Market Pulse, where we are going to be talking you through the Q2 24 consumer credit trends. My name is Becky Oakes. I'm the Vice President of Analytics here at Equifax, and I'm delighted to say I'm joined by Kathy Katsouleris today, our VP of Analytical Consulting, and Swanma Pandey, who is our Head of Insights. Before we get started, I'm just going to hand over to Sandra, and she will talk you through a bit about how the On24 platform works. Sandra.
Thanks very much, Becky, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try and address them throughout our session today. In the event there's too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Our presentation and a lot of related content in English and French are available for download in the related content area. And our session is being recorded, so you'll receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are reactions. Let us know how we're doing. Register now for 2 upcoming webinars, Business Trends on September the 19th and Fraud Trends on September 26th, as well as our survey, and Contact Us. Feel free to check any of these out and provide your feedback. We really appreciate it. Now let's get started. Becky, back to you.
Thank you so much, Sandra. So just to get started, we always like to take a look at what's happening in terms of the economy. Now, population growth has been a key talking point for quite some time. And in the second quarter, growth did actually remain quite steady. We saw 3.2% growth year on year in terms of population, which means in the last quarter, around 242,000 more people in Canada. Now, this growth level has been stabilizing, but we still see Canada being the fastest growing population in terms of the G7 countries. And there's been a lot of commentary recently in terms of in the media around some concerns linked to newcomer unemployment, particularly among some of the younger demographics here in Canada. And this has really led to a bit of a shift, and there was some announcements recently from the government around maybe some adaptation to the immigration strategy, particularly looking at things like temporary worker numbers and maybe slowing down some of that growth. Provincially, though, Alberta continues to see the fastest growing growth rate in terms of population, and that's really coming from interprovincial migration. So we're seeing more consumers picking up and moving to Alberta, maybe because the cost of living is a little bit cheaper in those regions. Now, that is having some good impacts in terms of Alberta economy-wise, because more people means growth for businesses as well, and kind of things like retail numbers are picking up. But obviously, we need to think about how that balances longer term with employment levels in that region. When we look at overall GDP numbers, the top line figures do indicate growth continuing in Q2, and actually the growth exceeded the Q1 numbers from what we've seen in terms of from Statistics Canada. What is important to note, though, is that that growth isn't yet keeping up pace-wise with our rapidly expanding population. So when we look at GDP per capita, this has fallen in the second quarter, and that's actually the 5th consecutive quarter of per capita GDP decline. So the top level numbers look good, but actually there is still some weaknesses in terms of the per capita side of things. In terms of overall unemployment, we have seen unemployment numbers been growing for quite some time. That is starting to plateau a little bit, which on that left-hand chart, that's the blue line. Now, if we consider that that trend in terms of the rise in adult population, though, that population growth, we are seeing employment ratio declining. Now, we've been seeing that for some time. It's actually picked up pace in Q2. You see that red line there? That is kind of the employment rate that has fallen. Now, this trend is a bit of a concern for us and actually for the credit industry. As we start to see employment rising, that can have more of an immediate impact when we start to look at things like payment behavior on the credit side of things, and probably more so than something like an interest rate change, where that can take quite some time to see the full impact come in. Unemployment is a little bit more of a shock factor, so that is definitely one to be keeping an eye on. If we look at kind of where the unemployment is growing the most, younger consumers are experiencing the most substantial employment rate declines, and provincially, Alberta and Quebec are seeing some quite significant drops as well, kind of followed closely by Ontario. Now, as I just mentioned, Alberta is seeing population growth, so it could just be a temporary thing that's happening there with kind of more people entering that province, and maybe employment hasn't quite picked up yet. Newfoundland and New Brunswick, they continue to have the lowest employment levels, and that's really linked to kind of the demographics within those regions. They do tend to have more of a older population, and actually that kind of links into kind of why those numbers tend to be a little bit higher than, or kind of lower than some of the other regions. In terms of on the inflation side, the inflation outlook continues to improve, with the latest figures showing a 2.5% year-on-year change. When we break that down into some of the key categories, mortgage interest still remains a key driver. That's up 2.5% quarter on quarter and up 21% year on year. Now, the recent interest rate drops may start to provide some relief going forward on that side, but still those drops are still relatively small compared to where we were 3-4 years ago, interest rate wise. So still going to need to be some pretty hefty drops to see that come back in line with what we saw historically. For those of you filling up with gas the last couple of weeks, you should be noticing that prices have come down a little bit at the pumps. So we've seen gasoline prices dropping 2% compared to Q1. They are still up year on year though. So that is something just to watch as well. And on the clothing and footwear side of things, we are seeing a bit of a drop still in terms of inflation on those areas. Now, some of that might be linked to a little bit of retail demand weakening. As you kind of get demand softening, then that can kind of lead to some of the kind of reductions we are seeing there. On the food side of things, that unfortunately has picked back up again in terms of what's happening in terms of prices. So that is still, again, a bit of a worry, because obviously that is an essential for kind of everybody. Now, if we kind of look at those inflation levels and compare them back historically, so on this slide, we're talking back to Q1 2020, you can see that increase in terms of overall CPI is up around 18.3%. But when we start to look at household incomes, they did rise during those periods, and in actual fact, they have outpaced inflation. Now, we did talk about this last quarter, if you're with us. This doesn't mean that consumers are unaffected. Just because we have income rising at a faster rate than the CPI, when we start to break that down into kind of different subsets of the population, we see that some parts of Canada, particularly for kind of higher income individuals, yes, we see net savings are rising. They're kind of up compared to 12 months ago and compared to pre-pandemic. But when you start to look at lower income, in fact, the bottom 3 quintiles, net savings compared to pre-pandemic are still down. So this unevenness across groups is a key factor, really contributing to some of the pockets of financial stress that we're starting to see come through. So one thing we did want to call out economy-wise, which we haven't touched on previously in some of our sessions, is what's happening in terms of the natural disasters and climate change and some of the impact that can have on the economy. Now, for this quarter, we're actually going to focus with a bit more detail on the wildfires that we've seen, but there's actually a growing list of threats. So if you think about this year, we've had flash floods in Toronto and Quebec. We had a recent EF2 tornado in Ayr in Ontario. We've had hailstorms in Calgary. And as these events increase, we need to prepare for their financial fallout and impact. So, for example, the Insurance Bureau of Canada, they've reported record high claims this year. In fact, I was seeing this morning on kind of some of the regular reports coming through that I think the hailstorms in Calgary caused $2.8 billion of damage. So, there was a significant impact from some of these climate events. We do see businesses that close down for a period of time. You may have consumers that need some kind of emergency financial assistance, things like deferral programs. So this really is an important one for us to be watching. Now, digging specifically into the wildfire side of things, last year was the worst year on record in terms of the amount of destruction that was done as a result of the wildfires that we saw across the country. And unfortunately, a lot of those fires that started last year, they didn't actually extinguish fully over the winter. So coming to this year, we've actually had a lot of those reigniting. I'm sure you've all heard about the ones in Jasper, for example, in Alberta. And Alberta, BC, Saskatchewan, the Northern Territories. When we look at the amount of damage that's been done already during 2024, that's sitting above the average for the last 10 years for those regions. So 2024 is going to be a challenging year as well. And there is some research that's been carried out by the Federal Reserve Bank of Philadelphia, and they've actually been looking at, okay, what is the economic impact of these kind of events? And their findings have been quite interesting. For example, if you get a region affected by smoke from wildfires, you actually can see a quarterly GDP per capita drop of around $7 for every day that there is a kind of a smoke effect happening. And then on top of this, when we look at regions affected by the fire itself, we start to see higher levels of net migration leaving the regions, that people are moving out of those areas. Probably unsurprisingly, we see house prices falling, in some cases, as much as 17, 18%. And there also are certain consumer segments where missed credit card payments are rising as well. So all of this is kind of, really crucial to consider when planning for kind of disaster response and forecasting. In the global context, when we look at the economy, countries like the US, Australia, and the UK, they're actually seeing quite similar economic trends to Canada currently. They're seeing inflation finally easing and employment starting to creep back up again. Canada's GDP per capita isn't really faring too well in comparison, though, partly because of that population growth. But if you are interested in seeing a bit more about what's happening in terms of Canada compared to other regions, we do have a global insight report that Equifax produces. You can go on our website and check that out. So that's kind of high level what's been going on. Kathy, I know you spend a lot of time talking to the industry, our clients. What parts of this are really important for you?
Great, thanks, Becky. So a lot covered in terms of the different factors impacting our economic landscape. But if I had to really sort of summarize the three key things that we need to be thinking about, it would first be obviously expect further rate cuts. We've had 3 rate cuts this year because the inflation rate numbers have come down. And now there's more signs of sort of that trend continuing. Again, we saw unemployment go up about 0.2% in August. So it's natural to expect further cuts. And we do have 2 remaining Bank of Canada announcements left this year. So all of which, hopefully is going to help stimulate growth in certain markets, like easing the payment shocks, those mortgage payment shocks for those renewing, and allowing first-time home buyers really to come off the sidelines and enter the market, and giving relief and easing that financial stress for certain pockets of consumers. Becky just went into quite a bit of detail, but really, being mindful of regional differences because of climate change impacts. Over the last few years, we've seen a spike in natural disasters like wildfires, which also impacts the consumer's financial credit health, right? Consumers that live and work in these regions may lose their home, or they may see their home prices depreciate. They may become unemployed, right? Or be laid off because those areas are evacuated or destroyed. And as a result, not be able to pay their bills, or they might have to seek out new credit. So this is really where, some consideration needs to be given in terms of assistance programs like deferral programs that, should be triggered immediately, ready to support these regions that are impacted by these natural disasters. On a side note, just, more and more corporations are adopting ESG, environmental, social, and governance standards as strategic business objectives, and doing their part really to reduce the carbon footprint and really promote sustainable economic growth. Last thing, Becky touched on it, but I'm going to just hone in a little bit more on sort of, we're seeing more and more small businesses be impacted with economic conditions. And they're finding it really hard to keep the lights on. And so they're either closing up shop or laying off workers, which again is contributing to that unemployment trend that we're seeing. So overall, there is some signs of relief in terms of the rate cuts, but there's also some opportunity to stay close to some of these growing trends and really monitor to see if you need to make adjustments to your risk policies. So I'll get into a little bit more detail in terms of what each lender type needs to be thinking about a little later into the hour. I think we're going to go back to looking at the trends for consumer behavior, and again, how the economic conditions have been impacting them. Back over to you, Becky.
Thank you, Kathy. Okay, so let's start to explore how these current economic conditions are kind of appearing in terms of some of the numbers on the credit side. And we've really observed 3 key trends for the second quarter. Firstly, early signs of slowing consumer spending, particularly when we look at the credit card side of things, We're also seeing some shifts in terms of pockets of financial stress, particularly now that's moving more towards younger consumers, and kind of that's starting to kind of evolve a little bit over the last quarter in particular. And then finally, we have these ongoing challenges in the housing market leading to kind of payment shocks for homeowners. At an overall level, consumer debt rose to $2.5 trillion in the second quarter, and that's driven primarily by a 5.1% year-on-year increase in non-mortgage debt. Now, while mortgage debt is still climbing, that pace has really slowed down as a result of those elevated interest rates. Within the non-mortgage debt side, credit cards are continuing to be really the major contributor to balances in terms of the rise that we're seeing. We've got above seasonal growth of 13.1% year on year on credit cards. And despite actually the high interest rates, we're seeing some products like the auto loan market, that's starting to see some improvements. We're starting to see volumes of new loans picking back up again, a little bit due to some of the rates starting to come back down again, but also really around vehicle pricing. We saw really high vehicle pricing during COVID when supply was quite low. We're starting to see that come down just a little bit, and that's helping those volumes in terms of new growth. When we start to look at consumer usage of products and kind of what types of things consumers are using on a credit file, we start to see a little bit of interesting movement. So this slide is showing the percentage of consumers with an active credit file who hold each product type and kind of how that's been changing compared to last year and pre-pandemic. Now, probably unsurprising, credit cards are the most commonly used product that we see on a credit file. So around 94.2% actually have a credit card on their file currently. And that's up compared to both a year ago and pre-pandemic. We're also seeing unsecured and secured lines of credit usage is up compared to pre-pandemic. But the growth has really been slowing down a little bit in the last year. Now, this general trend towards using revolving credit more is probably fueled a little bit to immigration and kind of the population growth, with newcomers to the country often using credit cards before they're kind of moving on to a product like something like a mortgage. But it's also probably linked to the impact of the economy and some of that increased reliance for credit for pockets of consumers. And there's also a little bit in terms of maybe a shift towards the digital purchases, which we saw pick up during the COVID time. That's really continued, and that's another reason why we've maybe got that higher usage of credit cards. Financial stress, though, is unfortunately on the rise. We have 1 in 23 consumers missing at least one payment on a credit product, such as cars, loans, mortgages, during the second quarter. This is an increase from 12 months ago. And while we're seeing this across all age groups, that uptick is really pronounced among younger consumers. So when you look on the right-hand chart, this is kind of how that's changing across the age groups. And you can see is the kind of the variations a little bit more for those younger individuals. As we look back over the last 2 or 3 years, where we've seen shifts in where this financial stress is emerging, post-COVID, when cost of living was rising very quickly, we saw this stress really be more evident for lower income consumers. As we started to see interest rate rise, we kind of saw that shift a little bit more into homeowners and the renewals and payment shocks. What we're seeing now is it's changing a little bit again. It's kind of evolving more into those younger consumers. We're seeing, maybe where we've got unemployment kind of levels rising for those younger individuals. So it's kind of evolved over the last 2 to 3 years in terms of where that stress is coming from. So it's really important, if you're looking at your portfolios, to really be thinking about where the arrears emergence is occurring. If we look at a product level, delinquencies are still rising across the board, with our 90+ day rates up year on year for all of the core credit products. And that's in terms of both balance and volume. So the left-hand side chart, that's balance delinquency. Right-hand side chart is volume. Most products are also showing higher delinquency rates compared to pre-pandemic. Mortgage is really the only exception, and part of that is because we saw a lot of growth during COVID. So our bottom number in terms of when you look at kind of delinquency levels grew quite fast. But we will dig a little bit deeper into what we're seeing on that mortgage side, because there certainly are some regional variations. But across the board, generally, delinquency levels are still rising, unfortunately. When we look at the insolvency side of things, consumer proposals, they're still the choice, the main insolvency type of choice for consumers. Bankruptcy levels have been fairly flat. We saw that dropping during COVID, and it's kind of stayed pretty flat since that point, but consumer proposals are continuing to rise. If we start to look at where we're seeing those rises in insolvency, that increase is particularly prevalent for mortgage holders in Ontario and BC in the last 12 months. We're seeing the fastest growth for that particular pocket of consumers, and that's probably linked to those provinces having higher mortgage amounts, higher house prices, and therefore that impact of interest rates on kind of renewals and things is going to be greater. And proposals are a great choice if you have assets that you want to protect. That's why we're seeing kind of in those regions in particular, if you have a mortgage, you probably you own your own home. If you are in significant financial stress, the proposal is probably an option that helps to protect your actual house. This quarter for our consumer deep dive, we're actually looking at, or we've looked at the rise of what we call multi-generational households. So this is where we are seeing adult children living with parents or grandparents. And the way we kind of look at this is we're looking at multiple credit files effectively within the same household. And what we've been seeing is that the trend is growing. So we're seeing more adult children living at home for longer. And that's really likely due to kind of high housing costs, those rising living expenses, and this piece around youth unemployment starting to rise. All of these factors are making it harder for those young adults to really be able to afford to move out. It's leading to delays in major life milestones as well. So things like, buying your first home, even starting a family, all of this is kind of impacting. In fact, if you start to look at things like the average age of mothers the average age of mothers at childbirth, that number is rising, particularly in provinces like Ontario and BC. Again, if you are living at home with your parents, perhaps you don't want to have a family yet. You want to make sure you've kind of gone out and got your own home before you start to have children. And so that age is creeping upwards. And this shift in family dynamics does have implications for the credit industry, because obviously, different needs for different types, different periods of your life. And so, you might start to see things like older relatives taking out loans and things to kind of help with things like deposits for kind of the actual purchase of a new home for the child, maybe offering more financial support ongoing. So it's really important to consider how products that you have can be adapted to kind of suit these changing family structures. So, that's high level view of what's been happening. I guess, do you want to pause for a few questions? I don't know if we've had any come in yet, Kathy?
Yes, I see a couple of questions. So there's a question on, with the increasing number of bankruptcies and large unsecured debt balances, are you modeling the impact of Canadians deferring payments on bank balance sheets?
Yeah, that's a great question. I don't think we have any numbers prepared in this webinar, but we certainly can do a deep dive into that in our Q3 session. So maybe we mentioned about natural disasters. Maybe we can look as well around, are we seeing deferrals come through on those kind of things as well? So let's take that away for Q3 and we'll do a deep dive on that one.
There's one more around, we would love to hear about the current trends that are impacting overall credit quality scores as this drives our approval ratios. Has the average credit score decreased in the last 6 to 12 months?
Yeah, so what's interesting when we look at credit scores, during the pandemic, we actually saw scores rising by around 10 points on average. So if we look at our ERS2 score as an example, which is an Equifax score, we saw the average score went up by around 10 points, from 744 to around 754, I think. Now that was due to kind of things like reducing balances and delinquency levels being low because there's a lot of deferral programs and things like that. We are starting to see that drop back down again. So I think it's dropped around 2 points in the last year or two, which doesn't sound like much movement, but credit scores are generally pretty flat. So even just seeing a 2-3 point drop on average, that's can be quite meaningful in terms of actual movement. So yeah, we are starting to see those credit scores starting to come down now from those kind of peaks we saw during the pandemic.
I think we can do one last question before moving to the next section.
Sure.
Is there still any lingering effect from COVID, or is that well past us in the consumer credit world?
Yeah, that's a great question. I mean, I would argue that some of the economic side of things that we're seeing right now, so things like inflation levels, things like high vehicle prices, high property prices, technically that's still fallout from COVID. Whether that was to do with supply chain issues, pushing prices up, or those low interest rates that led to house prices rising. I think some of that is caused by COVID, and we are still seeing some of the effects of that play out. Credit-wise, though, I would say we are probably back more to a normal position, if that makes sense. And by that I mean we have less of these super low balances that we saw on credit cards and things. We have delinquency levels back up again. So I think from a credit standpoint, we're looking more like trends we saw pre-pandemic now, but there definitely is still some lingering effects on the economy side from COVID. Okay. Well, let's move on then. I mean, we were talking a little bit about the house prices and mortgages. Swarnama, maybe if you want to talk to us about what's been happening there.
Yeah, sure. Thanks, Becky. Let's begin by looking at the overall state of the Canadian housing market at the end of second quarter of 2024. The market remained subdued. New home sales were slow, with properties staying on the market for around 4.5 months, which is twice as long as what we saw back in 2021. Although new listings are gradually increasing, they remain 10% lower than historical average for this time of the year. Sales to new listing ratio is weaker buyer demand relative to supply. Property prices, after a brief slowdown earlier in the year, are starting to rise back up again in most regions, except in the largest and the most expensive British Columbia and Ontario market, where they were held back due to reduced activity. Plus, elevated interest rates continue to suppress buyer affordability, which has contributed to slower market activity. And this trend was mirrored in our mortgage originations for Q2. Mortgage originations, they do improved by 21.3% from the lows that we saw back in 2023. However, they remain well below second quarter levels, reflecting a cautious market. The growth we are seeing primarily came from Alberta, where, as Becky mentioned, high levels of provincial migration has boosted demand. And despite the lower volume of new origination, loan amounts have not decreased significantly, and owing to persistently high property prices. High interest rates are further limiting the recovery of originations to pre-pandemic level and affecting affordability. These factors collectively contribute to the ongoing challenges that we're seeing in the housing market, and they affect different segments of mortgage borrower. Let's take a closer look at these segments. So our mortgage originations are divided in 3 segments. First-time home buyers, repeat buyers, and mortgage renewals and refinance. The proportion of first-time home buyer has decreased significantly to 23.5%, down from 27% back in 2021. And again, this is mainly due to high prices, elevated interest rates. But in contrast, the share of repeat buyers and multiple mortgage holders has increased now, with approximately 1.8 million Canadians now holding more than one mortgage. The third segment is, of course, the mortgage renewals, refinance. Mortgage renewals form the bulk of new originations, as these are mandatory in Canada. Renewals are becoming challenging for many, given the current interest rates, and many are facing payment increases. We have seen 15% of renewals in Q2 saw monthly payments rise by more than $300. And some are even extending the amortization term to manage monthly payments. So at the end of Q2, we've seen that over approximately 6% of mortgages now have amortization terms longer than 30 years. Given these challenges, it's no surprise that we are seeing changes in mortgage delinquency patterns across different regions. At national level, mortgage delinquencies remain below pre-pandemic levels. However, if you look at Ontario, it's an outlier where delinquencies have surpassed 2019 figures. The concentration of delinquencies in high-value mortgages in Ontario points to very specific regional and demographic pressures. Similar to Ontario, British Columbia is also experiencing rising delinquency rates, but at account level, the delinquencies have not yet reached 2019 levels. Taking a closer look at where these delinquencies are coming from, we see mortgages taken out in 2021, especially under low variable rates and high property prices, are starting to miss payments after 24 months, which is the current time period, indicating increased financial stress among borrowers after the interest rate hikes from 0.25% to 5% in a span of 16 months. Delinquency rates for more recent mortgages, particularly those open in 2023, are showing slower growth, suggesting some stabilization. But as we examine delinquency rate, it is also crucial to look at the behavior of loans that are at the risk of moving from early to severe stages of delinquency. So the roll rates for delinquencies are increasing, meaning mortgages are progressing from 30 days past due to severe delinquencies. The biggest increase is seen in the age group 25 to 31, which is mainly composed of the first-time home buyers who are struggling with the high cost of home ownership. And around 20,000 mortgages have missed payments, at least one missed payments on their credit file, with Ontario exceeding 2019 levels, and British Columbia is also seeing similar delinquency levels than what it was in 2019. The decline in self-curing, where borrowers actually catch up on missed payments, is also contributing to these increased roll rates. Monitoring these roll rates is vital for predicting future delinquencies for mortgages. To dig deeper into what all this means for the mortgage market, I'll hand it over to Kathy now.
Awesome. So thanks, Farnima. So before I do jump in, I'm just going to quickly recap sort of what we just heard to make sure we're all on the same page here. So Q2, we still saw a cool mortgage market where really apart from Alberta and people moving there because it's more affordable, there wasn't much activity happening from an origination standpoint. We also saw the decline in first-time home buyer market, really, again, because of sort of, like we said, the economic conditions and the high interest rates. And many consumers did experience sort of those payment shocks with the mortgage renewal. So really, that's the landscape of what Q2 was like. So in terms of what's trending, really, again, we touched on it. I'm going to touch on it again. Higher cost of living in Ontario. Really, it's stressing high value mortgage holders. And that results in why we're seeing a spike in these delinquency rates. And in terms of some early warning signs like missed payments and roll rates, well, we're seeing those increase, which means, again, you've got consumers that are not able to rebound from a missed payment and self-cure, and hence they're going to roll forward. And then that's where you're going to have sort of more delinquency, especially in Ontario. So I'm going to touch on first-time home buyers again. Again, given the few rate cuts now, there's optimism that they're going to be able to enter the market. But I'm going to throw out the big but, if anybody did an economics course, basic laws of supply and demand, right? If demand increases too quickly, what's going to happen? Well, you can expect that the home prices are also going to start to increase, right? And then what does that do? Well, it's going to stop first-time home buyers from being able to get it. So that, plus the fact that at the start of Q2, the government also discontinued that first-time home buyer incentive plan as well. So given all this, right? So these are the trends that, are emerging and currently happening. If you've joined us before, one of the questions that I love to ask is, if you're a lender in this space, what should you be thinking about? So for starters, again, we've got really vast regional differences happening here. So this is where these differences need to correlate back to your risk policies, both on the adjudication side and on the account management side. And so as the market starts to pick up again in Q3 and Q4, right, buyers are going to be super competitive. They're going to go out shopping for the best rate, which means as a lender, you need to move quickly on your decisioning process and really assessing the risk levels. On the renewal front, again, lock in those renewals early. What's the best rate that you can give? You want to minimize any attrition risk. But again, big key thing that I'm going to just sort of highlight here is you really need to understand the consumer's cash flow. And again, if there is an impact with regards to the payment shock, will they be able to take on this increased payment amount and sustain it over time? Okay. Last thing I want to just touch on is account management front, especially since we have those roll rates and delinquency increasing. You got to ensure that you've got a monitoring program in place, ready to identify any high-risk customers that match profiles where stress is coming through and from different regions. More and more customers, again, touched on it, not able to self-cure. So if they do miss a payment, you got to pick up on that sign and really sort of allow you to sort of hone in and monitor closely. And something that I've said in the past is it's really, really, really important to get the latest credit information on that consumer, right? You need to understand the overall picture in terms of their finances so that you got to make sure you have no blind spots. Okay, lots covered there, but I think it's time that we sort of tap into what's been happening into the card market. So Swarnima, back to you.
Thanks, Kathy. Okay. So let's shift our focus to another important aspect of consumer credit, which is credit cards. The credit market in Canada has also experienced notable trends in 2023. We saw huge growth in credit card originations, driven heavily by record immigration levels in 2023, as well as Gen Z consumer entering the credit space. In 2024, new credit originations was slightly lower than in 2023, but it's still a strong growth. And average credit limit on new card remained high, even though we saw a slight dip in credit limits from previous quarter, but they remain elevated across all score bands. Average limit on new cards right now is around $6,200, and this used to be around $4,800 back in 2019. So they've really increased a lot from what we had back in pre-pandemic. And this trend indicates ongoing consumer demand and some lender confidence in the credit market. With the increase in credit activity, now we are also seeing growth in overall credit card debt. Credit card balances have reached yet another peak in Q2 2024, driven by both high levels of new originations and increased credit usage. By 40% of credit card balance comes from transacting consumers, so those who pay their balance in full. The proportion of consumers revolving on their credit card balances has been on the rise, which is now contributing to the rise in delinquent balance, as those not paying their balances in full have now started to miss payments. Delinquent balances have increased by 30% year over year, highlighting the mounting financial stress among cardholders. And on average, consumers are carrying over $4,300 in credit card balance. And mortgage holders in particular are experiencing a sharper rise in credit card balances compared to non-mortgage holders, and sharper decline in pay rates as well, showing the spillover effect from the housing costs. Though average credit card balance is rising, we're starting to see a slowdown in credit card spending, suggesting increased reliance on credit for essential expenses. Adjusted for inflation, credit card spending is now lower than what it was in the past 2 years, reflecting a more cautious consumer behavior. So you might be wondering why spending is slowing when the balances continue to rise, and the answer to it is the reduction in pay rates on credit cards. As financial stress is rising, more consumers are actually making minimum payments, which is contributing to higher balance and prolonged debt. Younger consumers in particular are affected more. The rise in minimum payers is highest among the consumers under the age of 35. Again, the combination of high cost of living, rising unemployment is straining household budgets, leading to greater dependence on credit. These spending and payment trends are also closely linked to credit card delinquencies. We're seeing credit card account delinquency rates returning to pre-pandemic levels, reflecting, again, broader financial pressures across demographics. While the initial growth in credit cards helped offset some of the delinquency impact, we were not seeing actual rise in delinquency because of the huge growth that we saw in 2023. But now that effect is diminishing. As you can see, both balance level and account level delinquency rate for credit cards have risen. Younger age groups were particularly impacted, showing not only higher delinquency rates for cards, but also higher year-over-year jump in delinquency as they struggle to make credit card payments. Now let's analyze the performance of recent credit card accounts, especially those opened towards the last quarter of 2023, to see how they are faring. So if you look at recent credit card vintages, we're seeing that consumers have started to miss payments at a similar rate as pre-pandemic levels, especially accounts that opened towards the end of 2023 during the holiday season. Consumers with lower credit score at the time of origin are obviously missing payments at a higher rate than accounts opened in the same time period in 2019, posing a higher risk. A higher percentage of credit card balance are transitioning from 30-day delinquent to 60 days or charged off, and the rate at which the delinquent accounts return to current, or the cure rate, has also slowed down for credit cards, so indicating deteriorating payment behaviors. And to provide more insight into this, I'll ask Kathy to take over again.
Awesome. So thanks, Srinima. So in terms of the current and emerging trends that we're seeing here for the cards market, right? So given the economic conditions and really that high cost of living, specifically for housing and food, we are seeing credit card balances grow across the board, and more so for homeowners, right? And it's not because consumers are spending more, as we heard, but really it's driven by the fact that pay rates are actually coming down. We're seeing a lot more minimum payers out there, as well as more missed payments coming through, especially from that younger population segment. Another trend that continues to persist is really that these newer vintages are showing signs of delinquency as early as 6 months from the opening date. And while in Q2, we really sort of saw this being driven by the subprime and near prime populations, in the previous quarter, it was actually a lot of very good scoring consumers in that mix, okay? So again, if we pull all this together, what does this mean for the card market, and what should lenders really be thinking about or expecting for the balance of the year? So, for the balance, we typically see that, there is going to be growth in the card market, especially because you've got these big shopping holidays, Black Friday and holiday shopping periods coming up. But again, be mindful of the fact that, we do have these newer vintages missing payments soon after they've opened. So really understand where stress is coming from and it's being seen, and really sort of, look at continuously segmenting your portfolio and monitoring again for early warning signs and delinquency, and making sure your policies and your strategies are really tuned and optimized to minimize any risk exposure, right? Take a look at those line assignments. Are they aligned to the cash flow situation of that consumer, right? Do they have capacity to take on more credit or don't, right? Again, very important to be looking at that. Another key item is with regards to sort of behavior change over time, right? We've got a lot more consumers moving from being transactors to revolvers, right? And we're seeing those drops in pay rates or those roll rates increase. Again, slippery slope for some consumers that as a lender, you need to identify quickly and really sort of monitor. Otherwise, you're going to have sort of a collections issue downstream. Again, young Canadians, vulnerable cohort, hardest hit with regards to the unemployment standpoint. And again, they're the root cause where we're seeing a lot of missed payments come through from. So again, another cohort to be monitoring for risk. All right, I'm gonna put a pin in that conversation, and I think it's time we sort of shift some gears and start talking about auto. So back over to you, Swarnima.
Thanks, Kathy. Okay, before moving on to auto insights, I'll quickly explain how we divided the auto market. The auto lending here is split in two segments: loans from dealership and non-bank lenders, which we call captives, and the other is traditional bank loans. So let's first look at the overall market. Now, vehicle prices have remained elevated and has been a significant factor in shaping the growth and demand, even as the market is now showing signs of recovery. Auto loan balances have been increasing as a result of high vehicle costs, and growth was mainly driven by used car bank loans and captive loans. Now, new car demand and auto leasing took a hit due to affordability concerns and vehicle shortages, leading more consumers to choose used vehicles. And the slow recovery of new car loans and leasing indicates that consumers are carefully weighing vehicle needs against financial constraints. To better understand the balance drivers, let's look at the trends in auto loan originations and leasing activity. New auto loan originations rebounded from the lows of last year, but we're still below seasonal peaks of previous years. Loan amounts were at high vehicle prices and high monthly payments. Leasing activity also showed renewed growth after being low for the past 2 years, especially for high-value vehicles. Overall, captive loans provided by dealerships gained market share, reflecting consumers' preferences for these financing options. Bank loans are still significant, but are losing share, particularly new car purchases, which we'll see in the next slide. So used car originations and prices are starting to, used car originations continued to grow, and the prices are starting to lower from the peaks that we saw in 2022. But they've remained significantly higher than the pre-pandemic, as you can see from the chart on the left. Strong demand persists for used cars due to the affordability gap right now between new and used vehicles. The impact of price increases was visible from monthly payments as well. So the average monthly payment on used car loans in 2024 is now similar to what new car loans cost back in 2019. Therefore, from an affordability standpoint, used car loans are still more desirable than new cars for many consumers. Hence, we have not seen that surge in new car loan originations. And as we discuss the changing landscape of the auto loans, it is important to examine how these shifts affect the loan structure. So the rise in vehicle cost and higher interest rate has led to significant changes in auto loan structures, especially for used cars. For new car, interest rates went up. Zero interest rate loans were very sparsely available, while amortization term for new cars have remained stable. The terms for used car loans extended significantly, with many exceeding 7 years. So 44% of used car loans now have term 7 or longer years, and over 50% have interest rate above 12%. So these shifts reflect evolving loan affordability and increased risk, especially for lower income consumers. Now, with these changes in loan structure, let's look at the delinquency rates in the auto market. Auto loan delinquencies, again, reached their highest level since 2020. The last peak was 2020, and now we have reached another peak for auto loans, especially for captives and used car loans, highlighting heightening risk in this segment. Used car loans have shown most significant delinquency rate increases, suggesting the increased financial strain for these borrowers. New car loan delinquencies, while they're still lower than 2019, are still on an upward trend. But if you look at the vintages, we are all again seeing similar trend for captives and used car bank loans, missing payment at a higher rate 6 months from origin. Now, longer loan terms with high interest rates have contributed to higher delinquency rates for these loans. To better understand the future risk, we should also, again, look at the roll rates for these auto loans. So roll rates, again, the rate at which loans are progressing from 30-day to 60+ or charged off were increasing across all segments of the auto market. Captive loans have shown higher roll rates among younger consumer, while bank loan roll rates were primarily driven by used cars, with both under 25 and senior consumers having higher delinquency roll rates. That is close to 40% of their balances that were 30-day delinquent in June 2024 moved to being 60-day delinquent in July 2024. This indicates significant rise in financial stress for this demographic and shows that consumers are no longer able to catch up on their missed auto payments. This means used car loans are at a much higher risk of going into collections as larger balances move to severe delinquencies. Now, this concludes our auto section. I'll hand it back to Kathy for key takeaways for auto lending.
All right. So thanks, Ranima. So sounds like we've got some good news happening here in the auto market, right? With really, some rebounding thanks to the used car market and really not having any of those supply chain issues persist. And we also saw consumers really taking on leases for new vehicles and not just loans. And lastly, obviously with, the very high interest rates, we do continue to see sort of loans be structured where we've got those longer 7-year amortization terms to really lessen that payment burden and be able to spread out the payments. So some good news there, but I also heard some not so good news in terms of sort of the used car growth being good, but we're also seeing a lot more missed payments and delinquency for loans start to creep up because of that financial stress. And the pocket here that's really contributing to this is the subprime consumer base that, again, also have sort of these longer term loans and higher interest rates. Another key thing I just really need to sort of table is being mindful of fraud, right? We've seen a sharp increase in fraud applications coming from third-party fraud like identity theft, right? Stolen IDs, followed by first-party fraud where consumers, were falsifying information like their income, employment, or other financials, again, to get that loan approved. And when we double-clicked on that first-party fraud, we actually saw that the key segment that is contributing to this is really sort of young consumers with really low scores. So again, this is sort of the landscape. But again, if you're an auto lender in this space, what should you be thinking about or expecting for the balance of the year? So again, we talked about it, 3 rate cuts, possibly 2 more on the way. But this is where you need to be mindful of things like an early payout, right, from your less risky customers, and then being left with a book that is skewed to more risky customers. Again, good practice here. If you've got good portfolio management strategies or monitoring program, ensure you're able to stay close to make sure that, if consumers are showing some early warning signs of stress, again, you don't want to have a downstream collections problem. Additionally, we see the price of vehicles and especially used vehicles starting to come down, right? You do have that scenario where you might have negative equity where consumers who bought a vehicle during, the last few years at a much higher price point, they may have a loan now that's actually more than what the vehicle is worth. Okay, so be aware of that. From an education standpoint, again, make sure you're continuously adapting, optimizing your strategies, and layering really tools to help. If there's a lot of risk coming in through that subprime application base, and you've got younger folks also, but you've got that fraud activity as well. And this is where you need to be thinking about, do you have scorecards and strategies for these different segments? Are you incorporating key variables like cash flow, trended attributes? Are you able to identify applicants that are vulnerable, right? And are you able to identify fraud at the time of application because you're using consortium data? These are all the key questions that you need to be solving for with your teams. So again, you are able to align sort of your pricing offers to your risk levels. So I don't want to run out of time. Let's put this conversation in park. And I think we've got some questions that we need to answer now. I think, Becky, it's back over to you.
Thank you so much, Kathy. I know we have loads of questions coming in, so I'll try and fly through some of these as best we can. So there's one question: how do credit card debt levels compare to pre-pandemic levels? So as Swanema talked about, I think we had the credit card balances a little bit over 122 billion. If you go back to Q2 2020, that was 87 billion, so quite a significant increase. And the peak before that would be the holiday period, end of 2019, and that was, I think, around 100 billion. So still 22 billion, higher than it was pre-pandemic. Now, when we look at that at an average balance, that has also been on the rise. I think Swanema, is it $4,300, the average consumer card
Yes.
balance, I think, at the moment. So that definitely has been rising. Okay, so Swanema, for you, there was a question around Quebec specifically. Is there any particular impact in terms of interest rates on the real estate market in Quebec?
So mortgage delinquencies in Quebec, they're rising, yes. But if you look at pre-pandemic levels, it's way below when you look at Quebec for mortgages. So both balance as well as accountable delinquencies are well below the pre-pandemic levels. So it is rising, but it has not yet reached 2019 levels for Quebec.
Okay. Another question: how do the Canadian banks, or how are Canadian banks acting upon the consumer credit trends? Are they working on credit tightening or expanding? Swanima, I don't know if you want to take that one or.
So we are seeing some tightening in terms of adjudication process, because most of the new originations, especially in auto and cards, we are seeing now coming from high scoring consumers, and the share of low score consumers are going down. So definitely there has been some tightening for better credit score consumers.
Okay.
Yeah, can I just jump in there too, Becky?
Yep.
Sorry. Yeah, so obviously a lot of lenders obviously want to grow, but they want to grow with the right sort of risk level. So yes, back to sort of what Swarnima, just to echo what she said, part of that is sort of being more sort of cognizant of the risk and understanding sort of upfront, who are the good applicants that you want to let through the door and allow them to be on your books. So absolutely, we're definitely seeing some tightening happening in the market.
Yeah. There's a question around how fast can we expect the current trend of lowering rates to impact the credit card portfolios? So maybe I can quickly take that one. I think when we look at things like the mortgage portfolios, we know that really that happens. The impact of that is going to be, on the renewal side, those rates coming down. That's going to kind of reduce some of the payment shocks. Unfortunately, though, as we go into kind of next year, what we're going to have is consumers that originated those mortgages kind of 4 or 5 years ago, they're starting from an even lower rate than the renewals this year. So they're going to have to come down significantly to really offset that. So I think it's going to take some time before we see some relief on the delinquency side, or at least a reduction of some of those payment shocks. As you mentioned in the economic section, though, the unemployment rate is really the one that we're a little bit more concerned about right now. So that's the one to really be monitoring, because again, it's one thing managing through a period of high cost of living and high inflation levels and trying to budget and different things. If you no longer have a job, if you're no longer employed, that's it's impossible to pay off your credit commitment. So unemployment is definitely one to keep an eye on. Let me see if there's anything else we can get to quickly. Where are people spending their money most? Swanima, I don't know if you want to take that one.
Sure, but unfortunately, we don't have access to transaction level data for credit file itself. So we have an external partner who has this type of data. So we'll see if we can ask them to attend this webinar either in Q3 or Q4, so we can provide this breakdown for you.
Okay, fantastic. And I did see a few questions coming through in terms of specific areas of stress in the business side of things like that. I know we're almost out of time. So what I will do is we will try and go through some of the questions and kind of give a Q&A sheet post this. But if you are interested in what's going on the business side of things, as Sandra mentioned at the beginning, we have 2 webinars coming up. The first one on September 19th, where Sinead and Jeff are going to be specifically looking at business credit trends. So lots of interesting movements happening there. So highly recommend attending that one. We also then have the fraud insights and trends on September 26th. So Cheryl, Sarah, and Frederica are going to be digging into what we're seeing on the fraud side of things. And if that wasn't enough, Equifax is also sponsoring the CSRSA conference, which has been held 22nd to 24th of September at Blue Mountain. So if you're not aware of that one, Kathy and I are going to be on the main stage talking about artificial intelligence and how to drive value from that in the credit space. Carl Davis is going to be talking about fraud. So there's lots of great things at that. So if you're interested in that conference, take a look at the CSRSA website. And if all of that wasn't enough, my one ask before you leave us is please fill in the survey. And as Sandra mentioned it, you should be able to access it on the portal. It's really important for us to get your feedback, and it's how we improve our sessions and make sure that we're keeping this relevant for you. So apart from that, I guess Kathy, Swanam, and I just want to say a huge thank you for joining us today. We always have such a big number of you attending these, so really hope it's been beneficial. And we will, before the end of the year, have our Q3 update, so please take a look out for that. And we'll see you next time.